and welcome to BizTech's Asian Midday Market Watch. It's the 11th of August and we have as our guest today James Whelan, Managing Director of Amfex, the Australian Mutual Funds Exchange. James, welcome to the show.
Brian, how are you now?
Good, thank you. Now, James, we had an inflation print out of the US overnight that rose 3.2%, less than expected. What should investors read into this when making their investment decisions in the short run?
Read a bit into it because it's a pretty big number and it's pretty important, and it has come in lower than expectations. And the fact that it is continuing to show that disinflation is still moving in the US, that shows until it goes below that Fed target that the Fed won't actually start look at cutting rates at any time until that actually happens, until it gets below that 2% area. So right now it's good, it's okay. However, we did see that 10-year yields rose, but not necessarily off the back of it. We saw that the market was up, but then was reversed on, and we saw that 10-year yields rose. A little bit of Fed speak out last night, just saying expect higher for longer. I have a tendency to agree with that too. I think that they may not get risen anytime soon, unless there's some complete disaster. But I think that they'll probably be higher for longer for a while. Potential that we've got some recessionary inputs sort of kicking in a little bit as well. Maybe just to pay attention to them too. We'll probably come back to that in just a minute.
Now, on the flip side of the equation, we actually in China really are starting to seeing disinflation kick in. What are your thoughts on that and its impact, particularly in the APAC region?
Well, there's a fair amount of things that are all related to. So yes, the fact that it's not disinflation, I've been so used to saying disinflation as well instead of deflation that now it's funny to actually start talking about something being deflationary. We're actually seeing it that Chinese prices actually drop below that zero number. It's very interesting to see when you're talking about a year-on-year area. A lot of people saying now, there's a few things to take into this. Okay, so let's just unpack it first if we go through this one, Brian. The Chinese deflation, lower prices means exports cheaper, prices cheaper, things are cheaper. Now, there's a theory that is going to be exported deflation. Now, that would be great because you've got every single central bank in the world is trying to get a lock on inflation, and this would be a good way to do it. There's another school of thought which is coming out as well against that. So by exporting the deflation, I mean cheaper goods. People need to sell because prices are down. Cheaper goods flood the market, and that effectively brings prices down. Great. Welcome to Economics 101. The other school of thought is that what China actually exports or will be exporting isn't the sort of thing that is going to do much to keep US inflation down. The next piece of the puzzle is that if they've got deflation in China, then the next step is going to be more stimulus to try and pick up spending and try and pick up bits and pieces. Theoretically, that's sort of one way that some people are looking at it. That would not be amazing, and that would also help boost oil prices. We haven't really talked about oil yet, although that's a whole different kettle of fish. Now, if stimulus in China, in order to try and stop a slowdown in growth, because they do need to still grow, and growth means inflation. If you need to stimulate, then you need then oil prices will naturally go up, which does not help the US cause when it comes to inflation. You can see that this sort of the dog that is going to chase its tail all the way around the park and eventually come back around to the same situation that we're in before, which is that US disinflation doesn't go down as fast as the Fed needs it to do. I hope that I managed to get all that box of dice there for you.
And that's a tough one to unpack. So essentially, we have so many moving parts now. It's not clear how this is going to play out in terms of scenario.
No, you definitely can't say. I mean, you can give your best guess estimation on it. You can say that I think that if there is I'll tell you what, if there is a spike in oil prices even more, and if there's Chinese growth comes back online with huge amounts of stimulus, because they've barely even really commenced anything on stimulating, nothing close to what they did during the GFC. Now, this is them coming out of COVID. Do they want to do? They're not still a question mark over it. If they do, and oil prices do go up, that's probably going to be the key thing that actually eventually pushes the US into a recession, which is still factored in. A small amount is still factored in this year that could happen. US going into a recession then changes everything. That then means that rates do come down and everyone's bond holders suddenly start to go through the roof. So it's not necessarily a bad thing for bondholders, but a US recession is never going to be a good situation for their economy.
James, one of the things that's not happened from the very beginning this year, everyone was hoping for obviously a China-led recovery globally. That is, the China data has been very poor throughout the year, particularly consumer spending. Yet, the Chinese consumer has been very tightwad, but then we've got signs that the Chinese market is opening up a little bit in terms of travel. I think Australia and China have just opened up to group travel.
Yeah, that's big now. A whole list of countries have been added to the enable for group travel. Again, whenever I need to have a list, I don't really have the list in front of me. I hope that you do as well. What have we got? Thailand, Russia, Cuba, Argentina, and the second list, which is included Nepal, France, Portugal, Brazil. Australia added to the list today. Sensational, since I think about 30% of the revenue of our tourism companies comes from China as well. Extra flights being put on to be able to get Chinese people and Chinese group travel out of the country as more countries are added to their list. So positive for other countries as there. And here's the thing: that's them. That's not exporting deflation. That's them then going to be exporting inflation. If we want to talk about the same situation, the same problem that is causing so much angst at central banks all around the world, that's where we're at. So if we're going to have suddenly our ticket prices are already pretty high here in Australia, for example. I'm sure that the rest of Asia has a similar sort of situation. You can tell me from where you are, but
yes.
China suddenly sort of opening itself up more and more to be able to go out, group bookings and group spending, and a lot of people are still saving up from the COVID lockdown. This is not going to be helping our disinflationary attempts. So you can sort of see again, it doesn't solve the problem. Well, might solve the problem for China, but doesn't solve the problem for us. And I think that's the situation we're in.
And really, there's no quick fixes and no easy answers to this. James, thank you very much for your insights. Thanks for coming on the show.
Not a problem at all, Brian. Have yourself a good afternoon. Bye.
I'm Brian Fernandez, and we've been speaking to James Whelan, Managing Director at Amfex, the Australian Mutual Funds Exchange. This has been BizTech's Asian Midday Market Watch. This interview will be on our website, www.biztech.asia, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.